Welcome to the Leaders Insights podcast. Today's episode, IPO readiness, the financial infrastructure gaps that derail listings. A company spends 18 months prepping to go public, lines up the bankers, nails the roadshow, and then dies quietly in the diligence room. How often does that actually happen?
More than anyone wants to admit. The failures you read about are the market timing ones, because those are the ones with a villain. Rates spiked, appetite dried up. The quiet deaths are the ones nobody publishes. The auditors find something, the numbers won't reconcile, and the window closes while the company scrambles.
Give me the specific one. What just happened that made you want to write this?
The trigger for me was a restatement. A company having to go back and correct financials it already reported. There was a mid-market SaaS business, software sold by subscription, that pulled its filing earlier this year because its revenue recognition couldn't survive a full audit. Their systems booked annual contracts as revenue on signing instead of spreading it across the year. On paper, growth looked violent. Under the accounting rules, half of it evaporated.
So they weren't lying, they just couldn't count.
Exactly. And that's the part founders don't internalize. The public markets don't fail you for having ugly numbers. They fail you for numbers you can't defend line by line, on demand, with a paper trail behind everyone.
Define the financial infrastructure you keep talking about. That sounds like consultant fog.
Fair. It's three concrete things. One, a close process, how fast and cleanly you shut the books each month, that runs in days, not weeks. Two, systems that produce the same number twice. Three, controls, meaning a documented reason for every entry so an auditor can trace it. If your monthly close takes 30 days and involves a hero in finance with a spreadsheet nobody else understands, you are not ready.
How fast does a public company actually have to close its books?
A listed company files quarterly results within roughly 40 days of quarter end, and that's the entire process. Consolidate, review, audit sign-off, disclosure drafting. If your close alone eats 25 of those days, you've got 2 weeks for everything else. Most private companies I see close in 3 to 4 weeks and think that's fine. It's fine until it's fatal.
Isn't this what the CFO is hired to fix 6 months before listing?
6 months is where hope goes to die. Rebuilding revenue recognition, migrating off a system that can't handle it, and building a clean 2-year track record. Auditors want 2 years of comparable numbers. That's an 18 to 24-month job. Hire the CFO who's done it before you think you need them. By the time the bankers are in the room, the infrastructure decisions are already made.
You mentioned vendors sell software promising to solve this. Do they?
Partly, and I'll flag the bias. The close automation vendors, companies like Flowcast or Blackline, publish surveys showing finance teams drowning in manual work. And yes, they're selling the fix, but their underlying data isn't wrong. A big share of finance teams still close on spreadsheets. Software tightens the process. It does not invent controls you never designed. A tool can't tell you your contracts were booked wrong for 3 years.
What's the tell? When you walk into a company, what shows you in 10 minutes they're not ready?
I ask one question. Show me last month's numbers, and then show me the same month from your board deck in the spring. If those two don't match, and they can't instantly explain why, we're done. The second tell, I ask who can produce the revenue number if the finance lead is on holiday. If the answer is nobody, you have a person, not a system.
So the founder listening right now, pre-IPO, what do they do tomorrow?
Time your monthly close, honestly, from period end to final signed-off numbers. If it's over 10 business days, that gap is your project, not your pitch deck, not your story. Fix the close first, because everything the public market does to you starts there.
Fix the plumbing before you paint the house.
And do it 2 years early, or don't bother booking the roadshow.
Done. Want to know where you actually stand? Take the CFO self-assessment at mba-training.com.